So we're going to start off your trading and jump into things by looking at what I feel is one of the most overlooked aspects of trading. And it seems pretty simple, but knowing how to read a price chart, knowing how price action moves, and learning about structure. And again, you would think that anybody that uses technical analysis to make profit in the market, whether you're a counter trend trader, a trend continuation trader, an advanced pattern trader, even a mechanical systems trader, would know how to break down a price chart. But it's often overlooked. And one thing that I like to say is, how can you ever expect to do anything advanced if you don't know the basics? I think about it like a basketball player. If you can't dribble the basketball, how can you expect to do any of the fancy moves behind your back and in between your legs? If you're a baby, how can you expect to run without crawling first? So this is a very crucial aspect to your trading, and you want to make sure you have this down before moving on to anything else. Because if you don't know how a price chart moves, if you don't know what structure is, again, it's going to make it extremely difficult to put yourself in high probability trading opportunities, and really you're going to end up just gambling. So the first thing I want to go over is how the market moves, and the market moves in two ways. It's either trending or it's in consolidation. When the market's trending, it can trend either two ways. It can trend up, which is going to be a bullish trend, or it can trend down, which is going to be a bearish trend. When it's in consolidation, that's when you see that sideways movement, and the market's not giving you a clear sign of either bullish or bearish action. Now, if we go over here and take a look at a price chart, let me give you guys an example of how we like to identify a trending market. And we'll start with a bullish trend. When the market is trending bullish, it repeats a particular series of events, and it's new structure highs followed by outside returns or retracements. And you'll see the market consistently do this. We'll get an impulse leg up, creating a new structure high. Then the market will give us an outside return, and this is also referred to as a pullback or a retracement. Next, the market will give us another new structure high, followed by yet another outside return. And as long as this pattern is continuing of new structure high, outside return, new structure high, outside return, we know that the market is trending. Vice versa, if we were to look at a bearish trend or a downtrend. This time, instead of getting that new structure high, our initial impulse move is going to be creating a new structure low, followed by the same outside return, but this time the outside return retraces upwards instead of downwards, followed by a new structure low, followed by an outside return, new structure low, outside return, new structure low, and so forth. When we see this type of pattern repeating itself, we know that we're in a bearish trend. Now, the key point to identifying the trend is going to be that new structure high principle. Again, we'll start off with an initial move like this. We'll get an outside return. So we'll call this our starting point. After our starting point, and your starting point could be anywhere in the chart. You really don't want to concern yourself right now with, well, do I start on a 4-hour chart or an hourly chart? But if I scroll back 2 years, there's a lower low here. Wherever you first come into the market, for right now, use that as your starting point. It's going to be the easiest to identify. Now, that first initial move up, this is going to be your initial structure high. Now, at this moment, we still don't know if we're in a trend or not. All we have is an impulse leg. So our starting point to our initial structure high. Then, as the market pulls back, we get our outside return. And what makes this outside return valid is the fact that this outside return completes higher than our starting point. If the market were to push below this starting point, so our initial start, then this would not be considered an outside return. And we look at the market as being in consolidation. So as long as this outside return move completes above this starting point, and it could be right here, it could be right in the middle, it could be all the way down here right at it, this is going to be a valid outside return. Now at this point, we still don't know we're in a trend. We need one more thing. We're going to know that we're in a trend when the market pushes back up. So we have our starting point, our initial structure high, our outside return. The market's going to push back up to retest our initial structure high. And I'll go ahead and draw on a line here for you. Let's make this a different color. This is our crucial decision point. If the market is able to break and close above this level, our previous structure high, and in this case it's our initial structure high, this is what gives us a new structure high, and this is what confirms, in this case, the bullish trend. Now you're probably asking yourself, well, Akil, how do I know if it breaks it? Does the wick have to touch it, or does it have to close above it? And this is where we use a principle called the higher high, higher close technique. And I'll show you this the opposite way as well. In order for this to be considered a new structure high, our candlestick at this level has to create a higher high and a higher close than our initial structure high. So let's take an example. Let's say this red line is our initial structure high. The market completes its outside return. We come back up to test this level. Market's sitting right here, and you're saying to yourself, okay, I don't know whether this is a trend or just consolidation. It's all going to depend on what happens with this most recent candle. And I'll try my best to draw in a candle for you. Let's make this green because we're in a bullish trend. Again, what we need is a higher high, higher close. Beautiful looking candle, by the way. So if this candle throughout the, say we're on an hourly chart, throughout the time this candle is forming, if this candle spikes up here, but closes below this initial structure high, again, looking left, then we are still not in a bullish trend because we don't get that higher high, higher close. We get a higher high, but we do not get a higher close above this level. However, if this candle were to say close right here, we now have our higher high, higher close, and we officially have a new structure high. Once we officially have that new structure high, then we can say we're in a bullish trend. So again, we have our starting point. We have our initial move up, creating our initial structure high. We then have our outside return. And remember, this outside return must complete higher than the starting point to be valid. So again, the candle must close above the starting point. Once we start to extend from our outside return and we begin to retest the level of our initial structure high, that's when we're going to look for our higher high, higher close candlestick principle. And again, if our candle creates a higher high and a higher close than the candle right here, then we have another new valid new structure high. However, if the candle closes below this level, then we can't yet say that we're in a bullish trend. And this same principle is going to go for every new structure high or new structure low we create. So if we create a new structure high here, we come back, we get an outside return. Once we come up to test this new level, again, that higher high, higher close candlestick principle is going to determine whether this trend is going to continue or if we're going to see a reversal or consolidation. So as soon as we look left, find our previous structure high, as soon as we get that higher high, higher close at this level, we can safely say that we're still in a bullish continuation pattern. If we look at a bearish trend, it's the same thing, just inverted. So we have our initial starting point. The market creates a move down, giving us our initial structure low this time. We then get our outside return. Now remember, this time our outside return is going to retrace upwards, and as long as we don't get a higher high, higher close, as long as we don't push past the starting point, so we get a higher high, higher close past this starting point, then this is a valid outside return. The next thing we know to determine if we are indeed in a bearish trend, we need the market to create a new structure low, and that's going to be created by us getting a lower low, lower close at this structure level. So again, if the market is rolling down to this level and we're looking at our candlestick, if we were to get something like this at this level, where the market, roll this over some, there you go, where the market breaks below, giving us a lower low, but we don't close below that level, then we can't say we're in a bearish trend. However, if our candlestick closes beyond our previous structure low, then we can expect this trend to continue, giving us a new structure low, and we'll look for the pattern to continue. Outside return, new structure low after we get a lower low, lower close, outside return, new structure low. So let's take a look at this on an actual price chart with some candlesticks. So we'll call this right here, we're going to look at a bearish trend to start. We'll call this up here our initial starting point. We have our initial push down right here, from this swing high to this swing low, creating our initial structure low. And I'm going to say this ISL, initial structure low. Let's see if I can zoom in some here. There we go, that's better. Initial structure low. We then get our outside return, and you can see that it completes lower than our initial starting point. Then, in order to say that we're in a bearish trend, we can draw a line right here at our initial structure low, and we need the market to break and close below it. So create a lower low, lower close. You can see as the market pushes down, we test this level, but we never close below it. So at this point, we still can't say we're in a bearish trend. However, as you can see on the next candle, we create a lower low, so a lower low than our initial structure low, and a lower close as the candle closes right at this level. As soon as this candle closes or completes, now we have our new structure low. And as the market continues to drift down, all we do is drag this to our lowest point until we get another retracement. And you can see how the process continues. We get our outside return right here. We watch, we can drag our line down to our previous structure low. You can see the market comes down. What do we get on this red candle right here? We get a lower low, lower close. As soon as we get that, we can then say that we have a new structure low and that we expect our bearish trend to continue. And actually this comes in right about here. And you'll see the continuation. Outside return, lower low, lower close on this candle. So we get a new structure low. Outside return, lower low, lower close on this red candle, new structure low. Outside return, lower low, lower close on this red candle right here, and the pattern continues. Let's take a look at a bullish trend. See if I can find one going up. Here we go. Zoom in once more. Let's start right here. So down here we have our initial, or our starting point. As the market pushes up, we have our initial structure high. So ISH, initial structure high. You can see the market pushes back down, giving us an outside return. We do come down to test the starting point, but you can see we do not create a lower low, lower close. So this is a valid outside return. Let's see if I can actually, here we go. Adjust this a little bit. Boom. Now, this time, as we push up, you can see we test our initial structure high, but we never get that higher high, higher close. So we can't label this as a new structure high because we don't get a higher high, higher close above this level. So above our previous structure high. We then retrace again. And then eventually we push up. You can see we tested here again on this green candle. And eventually we get our higher high, higher close. You can see how this green candle closes above the blue line I have drawn in, and the blue line represents the high of our previous structure high. And at this point, we can now say that we have a new structure high, and we can say that we are in a bullish trend. Next, we get our outside return. We can bring our line up to our previous structure high right here. You can see that on this big green candle right here. What do we get? Yep, that's right. Higher high, higher close. So this becomes our new structure high. And we can watch the pattern continue. You can actually drag this all the way up to here if we want, because it keeps shooting up. We retrace down. What do we get? Outside return. New structure high. And you can see if I bring my line up, as soon as we get this higher high, higher close, which comes right here on this green candle, we know that we're in a bullish continuation pattern. Then again, outside return. Let's see if we get a higher high, higher close this time. We don't get a higher high. Yep, we just get a higher high, higher close right here on this green candle, just barely, but as long as it closes above it, it could be one tick, it still counts. And then eventually, you can see we break down, and this is a great example. We break down to retest our previous outside return. So if I draw a red line down here, you can see that after we get our new structure high up here, we get a big red candle down. Now this candle spikes and gets below our previous outside return, but remember, it has to create a lower low and a lower close for us to consider this a break in structure. So we're still in a bullish trend at this moment when we see this red candle. And if we click forward one candle ahead, we're still in a bullish trend. Our outside return is still valid. And then eventually, right here, when we get our lower low, lower close, this is when we can officially say the bullish trend is over. And then we just start our count all over. This becomes our new initial starting point. This becomes our initial structure low. So I hope that makes sense to you guys. And what I recommend doing is, before you move on with this tape, feel free to pause it right now. load up a chart and just start drawing the ebbs and flows in yourself. Start practicing identifying that higher high, higher close principle, that lower low, lower close principle, and see if you can draw some, see if you can identify some bullish and some bearish trends. And it's pretty simple. If you just scrunch your charts up all over the place, you'll see it. You'll see initial starting point. You'll see initial structure low, outside return, lower low, lower close. We have a new structure low. Outside return, lower low, lower close, giving us a new structure low. Outside return, lower low, lower close, giving us a new structure low. Outside return, lower low, lower close, giving us a new structure low. It seems remedial, but I promise if you draw this in and label it over and over again, what it does is it trains your RAS. So it trains your reticular activating system, the thing that makes just makes anything pop out to you. And before you know it, if you train it, if you keep practicing, you know, these trends and these lower low, lower closes, they're gonna pop out to you, and you'll be able to look at a price chart in no time and be able to identify a trend and be able to say, hey, the market's bullish, or the market's bearish, or the markets is in consolidation. Speaking of consolidation, consolidation is when the price action doesn't give you a clear direction of which way we're going. We know that a trend creates a certain repeated series of events. So the repeated new structure high, new outside return, new structure high, outside return, new structure high, outside return. Or in the case of a bearish trend where we're going new structure low, outside return, new structure low, outside return, new structure low. When the market's in consolidation, we don't see this pattern. We'll have our initial starting point and say create our initial structure high here. So ISH. We'll then get an outside return. We're just going to label this O for outside return. Then, instead of pushing up and creating a new structure high, we'll get price action that comes lower than our previous structure high. And then we may get a move that pushes past our outside return. After that, we may get a move in here, and then a move down that doesn't create a new structure low, and then a move back up that creates another structure high. And you can see that the market just isn't giving a clear direction of which way it wants to move. We never get that pattern of structure high, outside return, new structure high, outside return, or new structure low, outside return. We get new structure highs, then we get outside returns, then we get lower highs, and then we get new structure lows, then we get an outside return, and then a higher low. When the market is doing this, it's called to be in consolidation. And if you're a trend continuation trader, this is where you will lose money if you're not good at identifying the trend. This is where you'll get eaten alive. On the other hand, if you're an advanced pattern trader, this is where you'll see a lot of advanced patterns. And we'll talk about advanced patterns later in the training session. But when you get setups like this, you get Gartley patterns. When you get setups like this, you get butterfly patterns, you get cipher patterns. So depending on which style of trader, which style of trading you decide to take on, different types of market movement are going to offer you these different opportunities, and it's imperative that you know what we're in so you can prepare yourself for that type of trading strategy. Let's see if we can take a look at an area consolidation on an actual price chart. And we can see, oops, wrong button. we can see a lot of them. For example, right here, you can see how the market gets choppy, just no clear direction of which way we're going. We have higher highs, then we have lower highs, and then we have a lower low in here. Let's zoom in on this. We have our initial structure high here, then we have an outside return. Then we push up to try and make a new structure high, but we never get that higher high, higher close. So this level holds. And then we come back down and we get a new structure low. Then we follow that up just with sideways movements. And you'll see this happen when the trend runs out of steam. You can see it all over the place. Consolidation right in here. Again, no clear direction of market movement. Consolidation right in there. Consolidation right in here. A great example of one right here. Let's zoom in on this one. We look at price action. What do we have here? We have a new structure high. Then instead of an outside return that stays above our previous outside return, or our starting point here, what do we get? We get an outside return that tests this level. Looks like it either breaks and closes below it or comes right to it. Then instead of getting a new structure high, what do we get? We get a lower high right here and then another test of this structure level. So we're not getting a clear identification of either a bullish or a bearish trend. We're basically just going sideways, and you'll hear traders refer to it as just being in a sideways market. And again, when you get these opportunities, again, another one up here, you haven't learned about this yet, but this is where you'll get chances to trade advanced patterns like what looks to be a Gartley pattern right here, and make a little profit while you're in this channel. So now that you have a good idea of what a trending market looks like, what the market looks like when it's in consolidation, let's talk about structure. If we go back to our initial trending market, so our starting point, initial structure high, outside return. New structure high, outside return. New structure high, outside return. Let me go ahead and label these. Starting, oops, no cap locks. Starting point. Initial structure high, outside return. New structure high, outside return. New structure high, followed by another outside return, and so forth. Each time the market creates a new structure high or an outside return, the market is creating what we like to call a level of structure. And you've probably heard of structure referred to as support and resistance. This is the same thing. I like using the word structure because it kind of encompasses all of it at the same time. So when the market starts off and we create a new structure high, once we start to see this turnaround for our outside return, this level is now a level of structure, and this is going to be called resistance. As the market comes off of this outside return and pushes up, again, this is going to be our decision point. If we indeed get the higher high, higher close candlestick formation, then we know that we have a trend continuation. If this level holds, then we may have a counter trend trade on our hand. So it's very important how price action reacts when it gets to this level, and that's why we want to wait for that higher high, higher close candlestick formation to give us confirmation that the trend is continuing. Once we break that level, I should say if we break this level, we do in this case, if we break this level, as soon as we create this new structure high and the market starts to turn around again, this also becomes a trade, a level of structure. Now, our previous level of structure, which used to be resistance, which labeled as R for resistance, used to be resistance. After it's broken and penetrated, so after we get that higher high, higher close candlestick formation, this now becomes support. And what you'll notice is that when price action retraces to give us that outside return often comes into that previous structure level. So in this case, this previous level of support. Why is this important? Well, because if we're going to be trend continuation traders, this is where we want to buy at. We don't want to buy as the market's going up, because what happens is often you get caught entering the trade too late, and by the time you get your orders in, well, then the market starts retracing and you end up getting stopped out. We want to buy on this retracement. So after this new structure high is created, as the market creates this outside return and comes back into our previous structure level, one of the neat things I like to say is look left, structure leaves clues. Structure is like a magnet. Price action seems to be gravitated towards it. Once you look left and you see this outside return coming to this structure level, this is where we want to buy the market up in anticipation that this trend is going to continue and we can ride it up to the new structure high. We'll see the same thing in a bearish trend. We'll have our initial starting point. We'll have the market retrace. As soon as the market retraces, this initial low becomes a level of structure. This is going to be called resistance. As the market comes off of the outside return, it's going to come to this level and present us with a crucial decision point. What happens next at this level is going to determine, well, what's going to happen with the overall trend and also what type of trader we want to be. If this level of resistance holds, then we know we're looking for a counter trend opportunity, and we may be going into a reversal in trend. So we may be going from a bearish trend to a bullish trend, or we may be going into consolidation. If we get our lower low, lower close candlestick formation and we break below, then we know that the trend is going to continue. So then we want to ask ourselves, how can we get involved in the move? Akil, I've identified a trend. I've gone through, I've drawn all this stuff on my charts. I just saw a lower low, lower close. How can I trade the darn thing? Well, we wait for that outside return, which usually is going to come into this structure level. Remember, this used to be resistance. Once it was broken, resistance turns to support. So this level should support the overall trend. And once we get that outside return into that previous level of structure, this is where we look to sell the market. In anticipation that we're going to at least touch our previous structure low and eventually create a new one. Again, let's bring up a price chart and see how this works in real life. See if we can get a nice trend somewhere. Where's that first one we identified? This one works. So we have our initial starting point right here. Market pushes up, giving us our initial structure high. We then get our outside return. You can see as the market gets to this level, as the market comes off of this outside return and starts to test our initial structure high or our previous structure high, we start to run into a little resistance, and instead of breaking right through, it probes it a few times. You can see by the candlesticks on these or the wicks on these candlesticks. Eventually we get our higher high, higher close candlestick formation right here with this big green one, and we push up, creating a new structure high. Next, we want to label this area our previous structure high, and you can see as the market retraces for our outside return, we come into that same area, that same previous structure high area before extending up. Now, it's important to realize that the price action isn't always going to come right into that area. Sometimes it'll be a little higher, sometimes it'll retrace a little lower, but this is the zone that you want to be aware of. And you can see that even though we push a little lower inside here, the market still reverses, or our outside return still reverses at that zone. And later on, especially in the next chapter, we'll teach you some tricks on how to narrow down that zone. I'll teach you how to use Fibonacci retracements and Fibonacci extensions, and eventually we'll learn some techniques, some candlestick patterns, some simple formation techniques on how to trade this. But for right now, you want to be concerned with, again, new structure high, outside return. Where do those outside returns come into? Well, they come into our previous structure highs. So it once was a resistance level, which once was a level that the market had to fight through in order to break above. Once we get that new structure high, once we get that higher high, higher close candlestick formation, and we can confirm that the trend is continuing, that same level then will support the trend. And as we get our next outside return, it'll often come into that same level. Let's zoom out. You can see it again right here. What do we have right here? Structure level. Remember, this was our previous structure high. You can see the price action comes to it. Once again, it consolidates a little bit in here before eventually breaking through. As soon as we get that higher high, higher close candlestick formation and we break through, this previous level, which was once resistance, is now considered support. And you can see that as we get our outside return, where does it come to? Right in that same level, giving us an opportunity to buy. And you can see eventually the market pushes up to a new structure high. And this is a great example right here. You can see if I let's delete all this. If I bring my wick right to the top of this candle, and let's make this thin. If I bring my wick right to the top of this candle, which is our previous structure high, our resistance level, which is now going to act as support once it's broken. Look at these candles. Look how price action reacts at this level. It comes to it, and look how it gravitates around this level for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24 candles hug this line. If you don't believe that structure leaves clues, if you don't believe that structure is powerful, this is a perfect example. It hugs this line, and we cannot break below it. We probe back and forth, but we cannot break below it. And eventually, that line holds, and we extend up. And we'll see the same thing in a bearish market as well. Again, you'll see our initial push down, our initial structure low, followed by an outside return. We get our next new structure low. Again, fighting past this level, fighting past this resistance level, and I'll go ahead and bring my line up. Once we get this new structure low, this level of resistance is now support, and you can see as we get our outside return, price action comes right to it, right into this level, and eventually reverses down. Again, outside return, new structure low, outside return. Where does this outside return come to? Boom. Previous structure. Look left. Structure leaves clues. You'll see this over and over again. Outside return, or new structure low, outside return. Bring my line down. Where does it come to? Right on it. Again, the market will do this over and over again. So, a few things you need to realize. A, you need to know how to identify if the market is in trend, whether it's bullish or bearish, or if the market is in consolidation. B, once you have a good idea of being able to recognize a bullish trend, a bearish trend, a period of consolidation, I want you to start drawing in these structure levels. You gotta believe it. It took me a while. When I first learned about structure, I didn't really believe it. It's just the market just moves all wiggly, I said. But as you draw it in, you'll see time and time that these structure levels really act like magnets. Price action wants to go towards them. It wants to test that level. And once you believe that, that opens the door for everything else we're going to learn in this course. Structure is the most important thing in the market. Whether you're trading trend continuation, you're looking to hop on the trend at a retest, at an outside return, whether you're a counter trend trader looking for a double top, a double bottom, whether you're a advanced pattern trader trying to trade a Gartley pattern or a cipher pattern, structure is important in all of those techniques. So it's really important you know it. What I advise doing again is bringing up a chart, any price, any time frame, and just start drawing this stuff out. Earlier I told you to draw out the ebbs and flows of the market, practice on recognizing a trend. Well, this time just find a trend and draw out structure levels. Whenever you draw these lines, so swing low, swing high, draw a line there and start to recognize how price action reacts at those points. If it reacts a little bit, you have a minor level of structure. If it reacts a lot, say like a level like this, then we know that's a major level of structure and we need to be aware of it. We take a level like this where the price action hits it one time over here, twice right here, 3 times right there, 4, 5, 6, 7, 8, and so on. Levels like this are called major structure levels. And when we get into the deeper parts of trading, especially if you're a counter trend trader and trend continuation as well, it's going to be very important that we're able to identify these levels in advance. Not only is it going to keep us out of certain trade scenarios, but it's going to allow us to get in the highest probability of trades.